Check, check, check audio. And I'm seeing levels. Okay.
I was there. Okay. Thank you. So we talked about utilization. Has anybody ever heard of the 5 C's of credit? Okay, we're going to talk about it. Basically, your credit, a lot of people think their credit score is very personal. And really, it is your credit worthiness. Doesn't have anything to do with you personally. It's not a moral scorecard. It is strictly a number to show how you've handled your credit. So the 5 C's of credit, we've got character. Sorry, I have to use my cheat sheet. Reputation, reliability, your credit history. Are you paying your payments on time? Clear and simple. Do you have long-term payments? Capacity, the ability to repay, your debt to income. If you make $1,000 a month and you're looking to borrow a car that costs $600 a month, yeah, that's not a lot of capacity. That's a pretty high car payment for that kind of income. Ryan will get into all that kind of stuff on home buying. Capital, your personal investment. Are you putting money down? They call that skin in the game. If you're willing to come up with a larger down payment, you have a little bit more invested in it. You're most likely going to keep those payments up on that collateral. And then also the collateral. What are you buying? What year is the vehicle? What is it worth? Is there a lot of miles on it? All ties into the value of it, but those are things that go into the collateral. And then the conditions. The loan purpose. For a car, pretty simple. I need transportation. For a home, if you're doing like a home improvement loan, if you're doing a home equity type loan, well, what are you doing with these? Are you borrowing these funds to go buy another property, or are you borrowing these funds to improve the property that you have? Those all kind of are taken into consideration. Make sure you're paying payments on time, though. I can't stress that enough. I was reading one thing that said, if you're more than 30 days delinquent on a loan and it's reporting on your credit report, and that can take 2 years to catch back up by the time you get back on your payment schedule. If you have struggles and you can't make payments, make sure you're calling the collection department at the lender. They do not want to take property back. They don't want to take cars back. They really don't. They want to work with you. So many people think that, oh, this is horrible. I'm a bad person. It's no reflection on you. It's everybody goes through hard times. They will work with you. Trust me, they will work with you. Don't bury your head. Just let them help you. Very important when you're going for a car loan, though. If you've ever sat down with with a car salesman, they're going to say, how much can you afford to pay every month? Ugh, don't tell them that. Don't do that. Get pre-approved, or just don't tell them that, because when you do that, they're going to stretch out that loan to find that payment for you. They might stretch a car loan out 8 years to get you the payment you want. And you saw the difference in interest from 5 years to 6 years. Could you imagine if you're paying for 8 years? Because the interest is simple interest. It's not compounded like it used to be. It used to be you paid all the interest up front, and then if you paid it off early, too bad. I don't know that there's many car loans out there with those same terms. Now, most of them are simple interest. You're going to pay based on whatever the balance of your loan is that is remaining. So as you pay it off each month, the balance comes down. And that's when, if you look at your statements, you'll see principal and interest broken down. Those are going to change a little bit as you make those payments. A little bit more will start going to principal, a little bit less to interest. But don't ever tell a car dealer what you can afford, because they're going to, they love that. If you can't afford what they write up on something you've found, shop around. You can shop around. If you go to multiple car dealerships, if it's the same type of lender pulling your credit, it's obvious that you're shopping for the best deal. Now, if you go to United Nissan and then you go to Home Goods and apply for a credit card, those are not like inquiries. Those are going to affect your credit. But if you go to United Nissan, you go to Henderson Chevrolet, you go to Findlay Toyota, and they're all pulling credit within a certain amount of time, it's really not going to affect your credit, because you're being a smart consumer and you're shopping around. So once we've got our credit built and our financial health, some things that I highly suggest, and I actually did them all like within the last couple months, and it's very easy. All 3 credit bureaus, you can go in and just freeze your credit. You can, if you don't want to freeze it, you can just put a consumer alert on it. You build your credit up and you want to protect it. You don't build it up to have somebody, ruin it and apply for things without your knowledge. So put some credit freezes out there. And what that basically does is you can, and I really apologize, I didn't bring the 3 different credit bureaus and their phone numbers. You can either do it online or through their phone numbers. But you can freeze it, and basically you are giving them like a PIN number to unlock it. So only you will know that. I did them all online. No, I did one by phone because I couldn't figure it out online. But I did one by phone, and then the other 2 I did online. I entered the PIN number. So now if I want to go apply for something and I forget to unlock it, they're going to say, well, we can't look at your credit. We can't do anything for you. I have to go and unlock it by either calling, going online. But basically that means nobody can apply for a bank account, a credit card, a mortgage. And I say this because we've seen it happen. It's not just being exaggerated. People have applied for all kinds of things using other people's credit and information. So protect your long-term credit standing. Bank accounts, you can turn on alerts. If you have a debit card, you can go in and set an alert. I want to get a notification for any purchase over $50 or any online purchase or things like that. Credit cards, debit cards, most of those, you can set those types of limits and alerts. So not a horrible idea. It is just crazy the amount of fraud that we do see out there. Even the people that are being very careful, there are a lot of protections for us. So let's just use them. Phishing and fraud. Heard of those? You heard of the phishing? You get an email and it says, oh, we need to update your information. And it sounds like it's a company that you know, but if you look up at the address of the email, the full address, it's gobbledygook. Makes no sense. Obviously, it's not from them. I generally delete emails or texts if I'm not expecting it. If it was a real one, they'll find me eventually. But that is a great way to let them have access to your kingdom, your financial kingdom, if you click on a link that has fraud on it. Okay, understanding interest rate cycles. So basically, interest rates are like financial weather. They influence everything. Pretty simple. If the rates are rising, that's a great time to save. Not always the best time to borrow, but sometimes you can't help when you need to borrow money. And then obviously the falling rate. It's really funny in my years in the branches. I'd be helping a member and they're like, oh, those CD rates are so low, like a few years ago. And I'm like, I know, but you can get a car loan for 2%. Well, they're not, the people that are saving like that and are caring about the savings rates might not care about the loan rates. So it's never an even give for both ways, but that's just the nature of the game. But when the rates are falling, that might be a great time to refinance. A lot of people think they get a loan and they're stuck with that loan until it's paid off. Not a true statement. If you hear anything saying about lowering rates, that means you need to see about refinancing any loans that you have. Okay, that's all for me. Do you want to ask if there's questions for me specifically, or we'll wait until after? Okay. Ryan's up.
Everybody hear me okay? So thank you for Creson for covering the first part of our financial fitness little discussion here, right? As they said at the beginning, am Ryan Lopez. I have been doing mortgages for 25 years now. I started when I was in junior high school, and no, I'm teasing. I started right after college, and within a year of graduating from college, I was able to purchase my first home. And a lot of people say like, "Wow, how did you do that? How were you able to accomplish that?" And it was because I was working in the industry. And a lot of buying a home is basically knowing how to go about doing it. And a lot of times it feels overwhelming and it feels like you can't do it. So we're going to talk a little bit about that because in terms of your financial fitness, your housing expense can be one of the largest payments you'll have. So it's kind of important to know what you're looking at and know what you're getting into and all that fun stuff. So when it comes to getting a mortgage, often you hear someone say like, "Oh, I want to get pre-approved or I want to get pre-qualified." And a lot of times, consumers don't really understand the difference between the two. A pre-qualification is nothing. It's not worth the paper it's written on. A pre-qualification oftentimes will be someone will call me on the phone and they'll say, "I make X amount. How much do you think I can qualify for?" And in that scenario, I'll say, "Okay, well, based on what you told me, you make X amount a month. What kind of debts do you have? Do you have a car payment? Do you have school, student loans? Do you have high credit card payments, anything like that?" And then I can say, based on that, you could maybe qualify for a home of about 350 or something. But I don't have any documentation to support any of those numbers. I don't really know what the income is. I don't really know what their debts are. Did they forget that they have more debts than they do? A common one is people who have a lot of student loans sometimes won't mention them because they're not making any payments on them because they're deferred or whatever it might be. But we have to count those because while your student loans might be deferred for a little while, you're taking out a 30-year mortgage. And at some point, the odds are you're probably going to have to pay those student loans while you're paying your mortgage. So a pre-approval is what you really want to get to be able to go out and, make an offer on a home, let a seller know that you're serious about buying their home. A pre-approval involves submitting an application, sending me all your documents. If you're self-employed, I'll need tax returns. If you're a W-2 employee, I'll need pay stubs and W-2s, bank statements, all that document. I'm going to know more about you than you will by the end of it. Because when it gets so much documentation, we're going to have everything kind of, pretty much set and we'll know that you're pre-approved. We'll pull your credit report. We'll look at your debts. We'll calculate debt to income ratio. And then we'll run it through Fannie Mae or Freddie Mac or FHA or even VA, and they have like an initial automated underwriting engine that they're going to come back and tell us we like this loan or we don't. And at that point, I can hand you a letter, and then you can go out looking with your realtor and find a home you like, and then the process kind of continues from there. One of the big issues is that sometimes people are anxious and they don't want to take the time to submit all those documents and go through that process. And they'll go looking with a realtor and they'll find a house they fall in love with. And they're like, this is the perfect home. It's our dream home. It's everything we want. We love the school district. We love the yard. We love everything about this. And then I look at it and I go, you can't afford this, and then it's heartbreak, right? So there's a lot of that. So the most important thing is to get pre-approved. It doesn't cost you anything. We're not going to charge you anything. There's no fee for doing it at the credit union. We'll look over, whatever you might have and go for there. So of course, in terms of application criteria, like what are we looking at when we want to approve you for a home? We're going to look at your credit score. When we're talking about the 5 C's of credit and, whatnot, what kind of score do you have? Generally, you can go down to about a 580 FICO score and still be able to get approved for a home. But it's also going to limit what kind of programs you might have available to you, right? If you have a higher score, you're going to get better rates, better payments, all that stuff, right? Assets, this is going to be documenting that you have the funds you need to close. Do you have the down payment? Do you have the closing costs? Some loans require you to have a couple of months of reserves. They want to know that should something come up in the future, you have 2 months or 4 months or 6 months worth of payments to help you out in case something happens. And of course, in terms of assets and down payments, there's down payment assistance programs and all that kind of stuff to help you going. Employment history. This is one where a lot of people, sometimes misunderstand, right? Often they think you have to have 2 years of employment history, and you do, but it doesn't all have to be with the same employer. You just have to have 2 years of employment history. Now, let's say perhaps you were in college and you were studying to be a nurse, and then you graduate and you start a job. Once you start that job, we will count your previous education as employment history. So, and that works for all sorts of things. It could be trade school, it could be professions, just whatever you got your degree in has to match the occupation field that you're doing. So that's kind of a good way to, being able to purchase a home without having to wait 2 years. Income, we're going to calculate your income, and this is kind of a critical one because the underwriters don't look at income the way you or I might, right? You might look at your W-2 for 2025 and say, I made $60,000 and whatnot, but the underwriter is going to break down your income and look at it in different ways. She's going to look at what your base pay is and what your hourly rate is. What did that look like for the year? What was the year-to-date income on that? Did you make overtime? How much overtime? How often do you get this overtime? Here on the strip reports, we have tip earners. What kind of tips are you getting? How much is being reported? All that. So when they look at that, they're going to break that income down into different categories. And a lot of times they're going to do a 2-year average of that. And it's kind of a double-edged sword because if your income is rising, they're going to average it over 2 years. But if your income is declining, they're going to do a conservative calculation and take the lowest income that's more recent. So it sometimes they won't even count that if the income hasn't stabilized. So that's one of the things that's important to know when you're looking at income, because sometimes I'll get a self-employed borrower or someone along those lines or a tip earner, and they'll say, I make $100 and some thousand a year. And I'll say, well, what do you do? And they'll say, I'm a valet parker. And I'm like, how much of that is tips? And then they'll say, half of that's tips. Like, well, how much of that did you report? And often it's not a lot. So that's where it comes to existing debt. We're going to look at your credit report. Credit report's going to tell us what kind of debts you have. Car payments are a killer, especially nowadays. They're so big. A lot of times I tell people, if you are in the market to buy a new car and you're also thinking about buying a house, definitely get the house first, because a mortgage underwriter will say no. But a car dealership will find a way to get you into a car. You might have 20-some% interest or horrible terms, but they will do that. You can always get the house and then turn around and get the car after, right? So that way it doesn't hurt your debt to income ratio. But they'll also look at, some other debts you might not have. If you're paying child support, if you're paying alimony, things like that aren't on your credit report, we're going to look at that. But when we calculate debt to income ratio, we don't look at things like utilities. We don't count car insurance or car maintenance or food expenses or anything like that, because the debt to income ratio already has that factored into it. Normally, for most loan types, we can go up to a 50% debt to income ratio of what your gross monthly income is. The reason it's capped at 50% is because we know you still have to eat after you pay your house payment, right? You still have to pay for the heat, you have to keep the lights on, all of that stuff. So once we've kind of gone all through that and we issued you your pre-approval, you'll go out with your realtor, you'll find a home, you'll look for the perfect home that kind of meets what you're looking like. That process is a little bit involved. There's a little bit more to that. But once you get in contract and they accept your offer and now we're ready to go, at that point, we start talking about locking in your interest rate, right? And on a mortgage, the interest rate can be dependent upon a lot of different things. It could be your credit score, the type of loan you're doing, whether you're doing a VA loan or an FHA loan or a conventional loan, the down payment amount can change the interest rate that you're looking at. So all those things factor in. And what's also interesting about it is that the interest rate change every day. So you might call me one day and say, what's the rate today? And I'll say it's at 6%. And then you'll call me tomorrow and you're like, I want to lock in my rate. I'm like, well, it's 6.1 now. They're like, what happened to 6%? I was like, that was yesterday. Today, 6.125. You can lock or you can wait. You don't have to lock in, but at some point during that loan process, you're going to need to lock in the rate. And then we come to the loan estimate. Now, you may remember, back when I started doing mortgages, the loan estimate was referred to as the good faith estimate. They changed that a few years ago. The government came up with a new form, and it's more complicated than it was before. But that's what the government does, right? So when you do get a loan and you're shopping around for your mortgage, you definitely want to shop around for your mortgage, right? If you go to a mortgage lender and that mortgage lender says, don't shop around because it's going to hurt your credit score or something like that, it's because he doesn't want you to find a better deal, right? By all means, shop around. I often tell people, send me another institution's loan estimate. If it's a better deal, I'll be the first one to tell you that's a good deal. I would do that deal, right? And so the loan estimate will have the breakdown of your payment. It's going to have the breakdown of your closing costs. Does the loan include your taxes and insurance? Do you have mortgage insurance on the loan? When will that mortgage insurance fall off? All those kind of details is going to have a breakdown of the closing costs, how much you need at closing, right? You don't want to start thinking that, oh, I only need 20,000 at closing, and then you get to the end, you're like, oh, you need 30,000. That can't happen. It all has to be spelled out on your loan estimate. And on there, it's going to show if the loan's been locked in yet, for how long, and what those terms are. Because sometimes you'll talk to a lender and they'll say, yeah, I can give you 4%. And you're like, well, that sounds great. But what he didn't tell you is that 4% comes with 3 points. And now if you're buying a $500,000 house, you've got an extra $15,000 in costs that you didn't know about. On your loan estimate, that's all going to be disclosed. And there's certain fees that once it's on there and disclosed, can't change. So, if they give you that breakdown, then later you'll know this is it. They can't change these fees. Only certain items can change, like taxes and insurance or per diem interest and that kind of thing. Because of course, the number of months of taxes you might need to collect or the days of interest can change depending on when you close. If you close at the beginning of the month, you close at the end of the month, it falls to a different month, all those figures can change. So it'd be good if I had the remote to change slides. Hold on. All right, here we go. So, so types of mortgages, right? Everyone knows our favorite, the fixed rate mortgage. That's the vanilla loan. Everyone gets it. It's your 30-year fixed, 20-year fixed, 15, 10-year fixed. It comes in different iterations like that. There's talk about a 50-year mortgage, that we've heard. When I first started, there was a 40-year mortgage. Didn't really help a lot because it only changes your payment like $50 a month, but your interest rate's much higher. And just like the car payment that Creson was talking about, extending that mortgage payment out might only reduce your payment about $50 or so, but now you're going to pay a significant amount more in interest, like a significant amount. And that's what you'll see even on a 30-year loan. The interest on a 30-year loan, your average 30-year loan, is usually 1.5 times the price of the house. That's how much you end up paying if you make your minimum monthly payments over the term of your loan. So if you do a 20-year or a 15-year or a 10-year, not only do the rates tend to be better on the shorter term loans, but you're going to save tons of interest just because you're paying down that principal so aggressively. And so sometimes what we advise people is if you're doing a 30-year loan, if you can make just one extra payment a year, you'll usually cut about 8 years off of the term of your 30-year loan, right? And some people believe that like, oh, if I do biweekly payments, that does it. And it does, but it's the same theory because you're making one extra payment a year. Biweekly payments end up being 13 payments. if you can do 26 payments in half. So that's what you're kind of looking at there, right? Now, adjustable rate mortgages, this is kind of the nefarious like villain of the mortgage industry, right? It has a pretty bad rap from 2008. Everyone remembers the housing collapse and how that all happened. And a lot of it was because you had a lot of rookie loan officers that in this era, especially in 2008, there was no licensing required to be a mortgage officer. There wasn't any real criteria. That all changed in 2010. So it took the government a little while to realize, like, hey, maybe we should make sure people know what they're talking about. But what happened a lot of times here is that if you were taking out a loan, the rate looked much more attractive if you did this arm. You know, if you were going to get a regular rate at 6%, they would give you a 3-year arm, maybe at 3.5 or some rate like that. And then, but what they didn't tell you is in 3 years, your payment was going to change. It was going to go up. And sometimes even if they knew it, they would say, well, don't worry about it. The way house values are going, by the time that comes up, you'll just refinance and you just get out of the loan, no big deal. But then 2008 happened. And I remember getting those calls, right? Where they're saying, my payments went up. What can I do? And I said, well, let's look if we can refinance you. And you go, oh, your house isn't really worth more than what you bought it for. It's pretty stagnant. And so you're stuck there. So on an adjustable rate mortgage, you usually have kind of a teaser rate where for the first 3, 5, 7, 10 years, the rate has a lower introductory rate, but then starts to increase. In that era back then, the arms usually increased every year. So you would, once your initial period was up, every year the arm could start going up. Now they increase every 6 months. Right. So you could see where it'd be, your payment could increase rapidly if you needed to. And of course that can lead to you not being able to afford the payment increase. Now, the other really bad thing that happened in 2008 is that mortgage products started to get very interesting. They started to have an interest-only mortgage where you could actually just make the interest payment on the house and not pay the principal. And so essentially, if you had a 5-year interest-only period or a 10-year interest-only period, then for the first 10 years, you'd only be paying interest and nothing would be going towards the principal of the loan. And at the end of that 10 years, then whatever that remaining balance was would amortize over the remaining 20 years. And all of a sudden, you would have that 20-year payment. And a lot of times you couldn't afford it. The worst part is a lot of times this interest-only mortgage was coupled with the adjustable rate mortgage. So now not only did the loan start to amortize and your payment shot up because of the principal, but now your interest is climbing. And the 1-2 punch of that is kind of what created the housing collapse. Nowadays, if you're taking out an adjustable rate loan, though, they make us qualify you with the first adjustment taken into consideration, so that we know that at the end of 3, 5, 7 years, you'll be able to qualify then with that payment with the money you're making now. And of course, the idea is that between now and then, your income should be a little bit higher if we're doing that. But they're much more strict. Interest-only loans hardly even exist. You hardly even see them anymore. Every now and then someone will call and ask me, and I'm like, why would you want that? So they can be handy for investors. If you have investment properties and you want to keep your potential monthly liability down in case your house is vacant, but you have to know the product that you're getting into. And that's, again, where having a good mortgage officer, talking to your credit union, doing those kind of things can really help you out. Closing costs, right? These are the fees you pay to finance the house. No one works for free, so everyone involved in the loan gets paid, and this is where all your closing costs come from. You'll have your loan origination fee. That's what the lender gets paid for, right? Sometimes they have points, sometimes they don't. We have like a set fixed fee. So it's not like a percentage of your loan. So if you bought a $2 million house or you bought a $100,000 house, the credit union's loan origination fee is the same. Points will just depend on, did you want to buy down the interest rate? Did you want, if the rate today, we refer to it as the par rate today, right? To use a golf term, right? If the par rate is 6, maybe you want 5.5. Well, how many points do you have to pay to get 5.5, right? Certain programs also could have points if they're specialty programs or things like that, construction loans, land loans, those kind of things. Then you have the title company. They're going to do work, they're going to do title work on it. They're going to have fees on there. The appraisal, he's going to go out and appraise a house. He has to get paid. If you need a survey, that's usually through the title company, but they'll also have to get paid. The county has a recording fee that you have to pay the recording fee, right? And sometimes it can get tricky. If you're refinancing a house and perhaps you have your house in an LLC, and then when you go to close, you want to put that house in your own personal name, Well, the county is going to charge you a transfer tax, and that's $5.10 per $1,000 of the value of the house. So all of a sudden, you could have this extra fee just because you went from an LLC to being in your individual name. The loophole to that is to transfer it to a trust first, and then your individual name, and then there's no transfer tax, right? So things like that, mortgage interest, you're going to have per diem interest. That's what we normally would refer to that as your recurring and non-recurring closing costs, right? Your non-recurring costs are all these things up here like loan origination, points, title, whatnot. But your mortgage interest is a recurring cost. You're gonna, the minute you take that loan out, you're gonna start incurring interest. Mortgage interest is per diem. So every day that you have the loan out, they're going to look at the balance. They're going to calculate what your interest rate is, and then you have a per diem interest rate, and that's how they calculate it, right? So every day that you have the loan is how much they charge you interest for. The other recurring cost, of course, is taxes, insurance. Maybe you have to pay a couple of months of HOA up front. Just depends on where you're buying, right? And then in terms of final thoughts, right? Long-term financial strength start with small but consistent steps. Tonight is a great starting point. I always kind of think of financial fitness almost like regular fitness, right? It's all just consistency. If you keep your focus on your financial fitness, then you can budget and schedule and save and do all the things you need to get off to a better point. Good. Anyone have any questions? Any mortgage questions? Oh, we need a microphone.
Hold on one second.
Yeah.
Coming to you.
In discussing qualifying for a mortgage loan, what about retirees?
Mm-hmm. So for retirees, we will look at retirement income. We'll get award letters for Social Security, pensions, annuities, any of that, and we can use all that income to qualify.
Okay, can a retiree utilize the assets towards qualifying?
You can. Yeah, you definitely can. So if you have a large, let's say, annuity or IRA or any of that, you can definitely use those assets to help you qualify. You can even use the interest that you're generating off those assets to help you qualify as long as they're all declared on your tax returns, right? So, and of course, there's criteria. You're going to look at like 3 years of history for interest income and all the things. But if you're going to use a portion of those assets to go towards the down payment of the house or whatnot, then of course we can't use the interest from the portion you're using because it won't exist anymore. So that's all those things they'll look at, but they do allow it.
Okay, just a comment. I subscribe to Ben Franklin's neither a lender nor a borrower be.
Sure.
Okay, so
Mhm.
I can't stand owing anybody money.
Good.
And when it comes time to buy a vehicle, my attitude is you save up, you pay cash.
Mhm.
If you can't pay cash for the vehicle, you really can't afford it. That's my attitude.
I 100% agree.
So, I mean, my credit score is above 800.
Fantastic.
Has been there for years and years and years.
Mhm.
I have lots of credit cards. They're not business related, the Sears or
Sure.
Target. I don't believe in those kind of credit cards for a lot of reasons. But I pay my bill every month. I got my first credit card in 1967.
Okay.
And when I signed up for that credit card, I made a deal with myself.
Mhm.
The first month that I can't pay it off in full, I cut it in half.
Mhm.
So I think I'm pretty financially fit.
That's fantastic. Yeah, that's definitely great. We'd be out of work.
Oh.
By the time I was 28, I had purchased 3 homes, And a lot of my friends who were around that same age were like, how'd you manage to do that? And of course, they all had flashy cars because they were in their 20s and they wanted, the fancy cars to drive around in. And I pointed at my beat up old 10-year truck. I'd had it for 10 years at that point, and it had no air conditioner and this sweltering heat. And I was like, that's paid off. That's how I bought all those homes. You know? Mhm. We've got another question here real quick. Yeah.
By the way, thank you guys, did a nice job. I have two things I'd like you to define, because it's not clear, mortgage interest. I've had a couple mortgages in my life, never paid a mortgage interest, but I think that's if you have a larger loan on a house. But I'd like, it wasn't clear.
Sure. You mean like
Yeah.
mortgage insurance?
Yes.
Sure.
And if I could make a suggestion, one of the other things people need to do from the beginning, they need to have designated somebody if they get sick or hurt that can take over financial decisions, because you have to be able to talk to them. In a previous life, I dealt more on your side. I was a bursar at Major University, and you have to communicate, which you did an excellent job in telling us to communicate. But people need to know there has to be a designated to communicate, or you can't talk with them. So if someone wants to help you with something, you can't give them the information. So that's just one thing I would like to add in the definition. Thank you. What?
A financial power of attorney, I think, is what.
So in regards to mortgage insurance kind of gets a bad rap, but it's actually a great thing to some degree, right? It kind of came out of the Great Depression, when we had an era where people couldn't get home loans. And so through the creation of FHA, we got mortgage insurance, where basically the government came in and said, instead of requiring a buyer to put down, a large down payment, like 50% or more, the government insured those loans for the banks, so that if the homes defaulted, there would be some insurance, and therefore they would lend to buyers who didn't have such large down payments. FHA allows you to do as little as 3.5% down right now. And basically that's what mortgage insurance does, is it allows people to purchase homes without requiring 20% down or larger down payments. And so that's how that kind of works out. And so it does, a lot of people are like, why am I paying this mortgage insurance? It doesn't help me. But that's how it helps you. So, and if you're doing a conventional loan and you put down 20%, you don't need mortgage insurance. On an FHA loan, however, even if you put down 20%, FHA is going to charge you mortgage insurance, right? Now, if you utilize a VA loan, they don't have mortgage insurance. They have something else that's called the funding fee. And it's kind of their version of mortgage insurance. It's a little bit better though. And if you have any service-related disability, a lot of times you'll be exempt from the funding fee and they won't charge that to you. So, yeah. Any other questions? Sure.
Okay, coming back.
Yeah, I think in a general way, financial health is dependent on willpower. Okay. I mean, when I bought my home, I had a conventional loan. I put down a little over 20%. I took out a 15-year mortgage. I paid it off in 11 years. Because anytime I had any extra, I marched it down to the bank and made a payment toward principal. And then when you were talking about paying your bills, okay, I use my bank's bill pay. And, but I'm a control freak, so I don't want anything automatic. So as soon as the bill comes in, I sit down, I set up the payment. I don't make the payment until it's due, but I set it up in advance. I mark it down on the bill, what I did, so I have a record, because I'm old, I forget things. But
It seems to have worked for you.
Pardon?
It seems to have worked for you.
Yeah, okay, and I think a lot of people confuse wants and needs. And especially the young people. Um, I have to say, one of your items listed on once to me is Indeed, and that's my gym membership. But it's $10 a
Oh,
month,
yeah.
so, um, but for me, that's how I handle my stress, and it keeps me healthy.
Yeah.
Definitely.
This has a question.
So yeah, great information like building credit, but what's some, I know it's everything specific to a person's report, and I know it takes about like 7 years for bad things to fall off, but what's some good advice for rebuilding credit, like starting from a bad credit report to building it to something better?
A lot of it is the same as building credit, really. If it's a bankruptcy, if you've filed bankruptcy, once that bankruptcy is discharged, you are eligible to apply for a loan. Might not be able to get a whole lot of them, but you can start building your credit right away as soon as that discharges. And it's just baby steps. It might be, I have $500 in the savings account. Can I do a secured credit card? That's what I suggest to build it or rebuild it. Do a secured card. You're putting your funds on the line, and then the lender is giving you a loan. And as you pay that loan off, once it's paid off, your money's freed up again. But it shows you're responsible for having that money there and that you've made the payments. It's a great way to establish or reestablish credit.
And second question, like when do you think, this is not for me, but I'm just curious, like when do you think like it's when you need to like do bankruptcy? Like when is it to get to the point where like you need a file for bankruptcy?
You know, that is such,
I know.
it is a great question. And honestly, it's one that I have wanted to tell people that it's probably what they need to do, but unfortunately, I can't necessarily tell them that in my line of work necessarily. But really, if you've had a major life change and you just have taken on, too much, say you've gotten divorced, and okay, yeah, there's divorce decrees that say they're responsible for this, you're responsible for that, but guess what? You signed for those loans together. Lenders don't care what that divorce decree says. So maybe one of you might need to file bankruptcy to kind of clear it off of your side if the other person isn't taking it. It is a hard thing, but when you just get to a point where you just cannot make your payments and you have no other options, if you have a home, you know what, you might be able to do an equity loan to help consolidate some of that. If you have a car title, you might be able to combine, if you have 10 credit cards that are 15 to 25% interest, maybe you can pay those off with a 6% car loan, consolidate them onto there, one payment instead of the 10 different car payments or 10 different credit card payments, just consolidating a little bit more. There are a lot of options. What I really encourage though, before you say, I just have to do it, find a credit counselor, not a financial counselor with investments, but like a credit counselor. I am a certified credit counselor, by the way. But find them, or just go to a loan officer and just kind of say, or a branch manager anywhere at your financial institution, say, can somebody kind of help me see if there's a light at the end of the tunnel?
Thank you.
Yeah.
Questions?
Good.
I have a question for you, Ryan.
Yeah,
Strategic questions.
sure.
Let's say you are pre-approved for a mortgage that's $400,000,
Mhm.
and you find a house that you like that's $350,000. Do you write the pre-approval letter to the exact amount that you wish to offer, or do you write it for the higher amount, showing the seller that you actually have more financial ability than you actually are making an offer on the house? What is your recommendation on that?
So this, right, this is negotiation tactic.
Yeah.
It's so, right. And a lot of that will be dictated by your realtor, right? Because your realtor is the one who's going to negotiate with the seller to make the offer. And they'll have access to like the MLS and those information to see what's been going on in the neighborhood. So based on what they're looking at, a lot of times realtors will even get together, not really supposed to, but they'll get together and they'll call each other and say, how many offers do you have on the house? Right. And at that point, that'll tell them like, we need to come in showing that we're strong, or we want to negotiate because there's no offers on the house, right? So, you know, some realtors will take the tact of only show them what the price of the house is, what we're offering. We're offering 350, even though you're approved for 400, put 350 on the letter. That way they don't try and say like, hey, let's get 375 or whatever. Other realtors might say, show them you're approved for 400 and you can qualify with no problem, right? So it just depends on your realtor's negotiation tactic. So.
But you don't need to prove your worth to the seller by saying, I qualify for this much, but
Right.
I'm going to buy it for this. You don't have to prove yourself to them.
Yeah.
Prove yourself to mortgage.
Excellent, thank you.
Thank you. During your presentation, you indicated that you don't like anybody having access to your bank account. Uh, Welcome to the club. However, independently, you said that in order to build the credit, it's better to prepay or set up automatic payments in several, as many as accounts as you may have. Isn't one thing consistent or the other?
Well, the automatic payments that I'm talking about, are you setting them up through your bill payment or the online banking? Yeah, no, that's my personal feeling is I don't want them coming in and taking it out when they think they want to. I'm going to go on, I'm going to log in. I pretty much do it weekly. And as I get that bill, I set them up and I go in, and some of them I set up to be an automatic set amount every month. Like the utilities, you can do the equal pay type thing. I do my own equal pay. I guess I have a little bit of issues with people trying to control. I don't know, but I do my own, and I just set the same amount up every single month for those. But yeah, the automatic, I mean, is you're setting that automatic up.
And I think this is kind of a personal preference too.
Yeah,
depending
it is.
on what you're liking. Sometimes just live and learn. I once had an experience where I had everything set up to just be paid out automatically. And there was a glitch or an error where one of my mortgage payments was made twice. And then all of a sudden I'm like, oh no,
Yeah.
right? This payment got made twice. And luckily there were some reserves there. But after that, I changed it where those didn't get made automatically. So smaller payments did. And like the mortgage payments, I go in and make the mortgage payment on my own every month on all the homes that I have. So
What I will suggest is if you are going to set up through a company and have them pull it, it is fine. A lot of people do it. I would suggest giving a debit or credit card number instead of your routing number and account number. It's easy to turn off if something happens on your debit card and say they're hacked. You know, the state was hacked last year and different things you can turn off your debit card and they're not going to do a whole lot of damage. But if they get a hold of your account information because of a hack, it's a little bit harder. And that's your account number. You have to change all of that.
Along the same lines, when I shop online, I really don't like my credit card going to all these different websites. So what I do is I opened a PayPal account and I pay with as almost anything, any website that is retail
And most
accept PayPal. There are a few where I have to actually give them a card number, but this way, and I have credit cards registered with PayPal so that if there's not enough money in the PayPal account, they automatically get it from the credit card. But at least my credit card is
Right.
not on 20 different websites.
And some people apply and have a separate, like, smaller limit credit card, maybe a $500 or $1,000. And that's what they do for their online purchases so that their main cards.
Except I have a hard time with those low limit credit cards. They keep increasing it.
I know.
It-
Because you
you-
pay your bills.
Well, usually if you keep getting solicitations of people wanting to lend you money, it's because you don't need the loans.
Okay, thank you, Ryan. Thank you, Creson. Thank you, Cameron. Thank you, Alexis. Thank you, everyone, for being here tonight. And
thank
we'll
you
see you
all.
next month.
For having us. Yeah.
Oh, you're too sweet. I need to ask you something. Were you looking at the budget sheet?
No worries. Thanks for coming.
Thank you. Backside.
Always.